Tuesday, February 6, 2024, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at why the Bank of England is going to continue to sacrifice the purchasing power of the pound in your pocket. I say this with no glee. And before I continue, though, just wanted to talk a little bit about what I've tried to inform the public about with my channel ever since late 2015. And we have to go back to maybe the beginning of the century, early 2000s. And that's when I learned about the nature of our fiat currency system, how the only way to keep perpetuating it is through more and more debt, and that it would eventually lead to the destruction of the purchasing power, not just of the pound sterling, but also the US dollar, the euro, well, all fiat currencies, all currencies in the world today. And I warned, of course, friends, colleagues, and family members about it. And the first question they ask is, how do I protect my savings against that? Apart from investing in the stock market, which can be quite up and down, of course. Well, I learned that there's something called sound money back then as well, and that it had been around for thousands of years. And I'd never looked into it, even though I have an economics background and a background in the city of London as well in finance. And I found out that gold and silver were sound money. And I started accumulating physical gold and silver. And I have no regrets. As you can see here, the performance of gold ever since the year 2000 has been pretty steady. It hasn't performed like Nvidia or Bitcoin, but it's been pretty steady. As you can see, in British pounds, it's up over 10%, roughly per annum, ever since the year 2000. In dollars, it's 9.3. So the purpose of this channel, which I started making videos for it back in late 2015, was to warn the public, you, about this system. Warn them like I had friends, family, and colleagues. And many of you got the message and asked me, where can I get gold and silver? And in the beginning, this wasn't the purpose of the channel to have people go and buy gold and silver. And yes, through my recommendation, but it's turned out to be so. And I think it's more important than ever, even though gold, for example, has gone from around 700 pounds when I started this channel to around 1,600 now, from around $1,000 to just over 2,000. I think it's more important than ever to try to protect your savings. Leaving your savings in the bank or in a bond, in my opinion, is going to continue to be a losing strategy. And we're going to look at why, and why the Bank of England and all other central banks, for that matter, have no intention of eradicating inflation, because it's their game. Inflation is their game. And I have, of course, playlists that explain that. One is the inflation files. You can go through all the videos I have there. The other one is about the UK debt time bomb. You can go through that because it's all related to the debt. So I'm not advising you here. I'm just saying, if you haven't done it yet and you think it's important to protect your savings after you've listened to me, or even not even after you listen to me, but after you do your homework. You need to do your homework and be cognizant of what's happening yourself. You need to do your own research. But if you do, I do have affiliates in the description, not just here in the UK with Gold Investments, but also in the US. So I say that as a friend, as a YouTube friend, as a part of the Monaco 64 community. And yes, and shop around. If you can get better deals than from my affiliates, go to the better deal. But one thing I would say, my affiliates are reputable and they've been in business for decades. So back to the Bank of England. And many of you might be asking, if you're new to the channel, well, what are you talking about? The Bank of England is fighting inflation. No, they're pretending to fight inflation while they inflate as much as possible. Because in a fiat currency, a debt-based system, especially when they kind of lose control of it a little bit, like they have in the last few years with price rises, they have to pretend to the public that they're fighting it, but they're actually continue to inflate. And many of you, of course, who haven't watched me for long or maybe here for the first time, think that inflation is the CPI. Well, I've got news for you. Inflation is the creation of currency and credit out of thin air by the banking system. First, via the central bank, through the fact that they create reserves out of thin air. And with those reserves, they buy government debt in the secondary market in order to replenish the coffers of the commercial banks. And the commercial banks, of course, with those reserves, they lend it out to you in the form of loans, mortgages, and that creates currency out of thin air. That's all it is. And prior to 1971, the whole system was based on gold. The United States dollar was backed by gold. For $35, you could get on demand 1 troy ounce of gold. Not the public, unfortunately, but the treasuries of the world. But Richard Nixon closed that gold window, so to speak. And he put the United States dollar, which is still, for now, the base of our monetary system. He put it on. He took it out of. He took the gold anchor out, so the dollar is based on really nothing except all this government debt. So the more debt there is, the more currency there is, the more the economy grows. The problem is that with every pound or dollar that you issue in debt, you've got the interest to pay. So there's never enough currency there. So if you pay off the debt, if you raise interest rates, you destroy the system. And what this does, especially since 2008, where the central banks and the governments on your back had to bail out the banks, and a lot of people, for that matter, that mortgaged themselves up to here. What's happened is that the amount of currency has overwhelmed the real economy, and it's a simple law of supply and demand, where the more you produce of something, or especially out of thin air, the other things that take effort and time to produce become a lot more valuable because they're not as easy to produce. It's as simple as that. And that's what really currency debasement and inflation is. What we see in terms of the CPI, which is the Consumer Price Index, is the consequence of inflation, is how much more you're paying for consumer goods. And they've brainwashed over the last 40, 50 years, even economists and people at universities, they brainwash people into thinking that CPI is inflation. So if CPI is falling, inflation's falling, and vice versa. And they do everything to tinker with that number, the statistics, and I've even covered it. I've caught the ONS, the Office of National Statistics here in the UK, changing the CPI methodology flagrantly, and I've even spoken about it. You can listen to my video from July 2022. Bank of England flagrantly fudges inflation data. I have another one from July last year, the shocking truth about UK CPI. But to put it in a nutshell, the government told the ONS, probably along with the Bank of England, to basically revise all the CPI data back to 1949. And I'd been following that data. That's why I caught the fudging and the change of history. So what that did, for example, from 1997 to 2000, the CPI average dropped from 2.7 to 1.9. And I've been following the Bank of England inflation calculator, and you see that in my videos. And I knew that prior to that, it was 2.7. And that's why I caught it. And why is that period important? Well, it was because in 1997, Tony Blair gave the Bank of England independence, but they had to keep a target for CPI of 2%. So now with this change of history, the CPI magically was at 1.9% for those first 23 years of the Bank of England. So they can come out now and say, we've been fighting inflation, which is really not inflation, the CPI. But anyway, back to why they're going to continue. And I highly recommend you watch these two videos, and I'll put it up in the cards. Yeah, let's continue and see why they're going to continue to inflate. Well, first we need to start with interest rates. And as most of you know, unfortunately, interest rates have risen a lot in the last two years or so. And they've risen a lot only because the Bank of England and the government, they conspired to keep rates artificially low, around zero, since 2008. And which is totally unnatural, because if you go back 300 years plus, the average interest rate in this country has been around 5%. So the fact that we're now at 5% is nothing special. It is special for us because they kept it artificially low for so long. How do they do that? Well, through printing more reserves, the Bank of England, and buying that government debt through QE. Of course, they're trying to reverse it now, but they're losing control. And interest rates, of course, topped back in September 2022 when we had the Kwarteng Trust crisis. They've kind of stabilized. They've gone down a little bit since October, but this year they're starting to rise again. And I think the Bank of England is worried about this because it's going to kill the economy. Of course, we are a consumer debt-based economy, and yes, we depend on high house prices, real estate deals. We depend on the City of London. We depend on our pensions, and we saw that pensions almost exploded back in 2022, especially the defined benefit private pensions. So yes, they can't afford to let interest rates and bond yields continue to rise, because we got so much debt, right? And the higher debt servicing goes, the worse it gets. The more debt the government has to issue to cover the servicing on the debt, it's a cocktail for disaster. It's the debt time bomb. So they've done their darndest to pretend that inflation is dropping. And this just came out this morning in the FT, and it says, Bank of England official sees interest rate cuts as a reward for lower inflation. Chief economist Huw Pill, ex-Goldman Sachs, says underlying price growth does not need to fall to 2% for easing policy. So there you go. They're already talking about cutting rates. And they're saying, don't worry, we don't need to go back to 2%. Well, you should be raising rates right now still, because there's still a lot of inflation out there. And the other thing you hear from these people is that they're going to blame the consequence of inflation, like people asking for higher wages. They're going to say that is inflation. This guy is already blamed, not only him, but his boss, Andrew Bailey. They've blamed higher wages for inflation. They've blamed trade unions for inflation. No, they're just reacting to the fact that the Bank of England is creating the inflation, and the currency that we have to use is continuing to lose value. So, and who knows, maybe in a year or two, the ONS is going to change methodology again, and magically the CPI is going to look a lot lower, and the Bank of England is going to say, oh, look at that, we've kept inflation in target, or CPI. And the Bank of England is supposed to write a letter to the Chancellor of the Exchequer. That was one of the conditions when it was given independence by the Labour government, to tell them why the CPI is 1% above the target. So it's really easy to debunk this revision we've had since 1949, because we can show by these letters that they were really busy writing these letters after the '08 crisis. And I think they've probably given up writing these letters now, because CPI has stayed well over 3% for many months, a couple of years or so, or 3 years, who knows. So that's why it's a problem. And it's a problem also for pensions. I've seen that there's a lot of talk now that they're going to raise the state pension age. It came out, I think, during the weekend. It says people born in 1970 could have to wait until they are in their 70s to get the state pension. As reports warns, costs are becoming unsustainable. So what's this all about? My state pension age is 67. When I started working here in the early 90s and got my national insurance card, it was 65. Hopefully it won't change again for me, but why is that happening? Well, it's more than just the debt, I would say. Yeah, the debt is a problem. Government is running out of money. It's having to borrow more and more. And we have this inflation problem, right? We got interest rates going up. But the other one is that when the state pension was created in the early 1900s, really very few people could claim it, because a mortality rate, or the age at which people died, was around 65, the average. It was probably even lower. So very few people actually claimed the state pension back then. But as people have become, I guess, healthier or have lived longer, that's created a problem. And also with the fact that people in the 60s were encouraged to go to work, so to speak. Women were encouraged to go to work with the women's lib thing. More and more, mothers went to work, people had less children, and now we've got this demographic problem, and this is what it's all about. And that's the other reason why I wouldn't put too much faith and confidence in the state pension, and that's why I'm happy that I've been able to get a hold of some physical gold and silver throughout the years. So yeah, I'm going to stop right here. I'm sure some of you will be disappointed. I'm not going to look at the markets. I don't want to keep this going for too long, but suffice it to say, things are fairly quiet. Gold is pretty much unchanged around 2025. The currencies have rebounded a little bit. The dollar was strong yesterday, But one thing I would say, yeah, the bond markets are pointing to yields going higher, and that's a bad thing, and we're going to keep an eye on that. I think that will be problematic for Mr. Andrew Bailey and for Jay Powell as well. So with that, I'm going to wish you all a very good day. Take care. Bye.